The equity market in India is down as much as 13% from its lifetime high that it touched in the month of September, 27th September 2024 to be exact. Now, in addition to that, if you look at data just this year, year to date from Jan 1st, 2025, the Sensex has crashed over 3%. Now, despite the small cap and mid cap stocks being a little in the green this morning, overall wealth erosion as much as 20% on small cap and mid cap stocks has been seen since the 1st of Jan. Now, investors have lost as much as 45 lakh crore rupees on the BSE listed stocks alone since start of the year. Now, if you look at this data from the 27th of September when markets were at their all-time high, investor wealth has eroded by as much as 78 lakh crore rupees. So what are the pain points and why is the market in such dire pressure? Well, what seems to be driving the downturn right now are two key factors. First among them being the tariff threats by Donald Trump, and this is keeping FIIs on the edge. FIIs continue to exit India and bet on a much stronger dollar. Now, if you look at some data, $25 billion have been withdrawn by FIIs since the September high. The fund manager's allocation to India is at a 2-year low, and all of this seems to be because of what is happening globally, especially with respect to Donald Trump. But on the domestic front, the Indian story also continues to be weaker than it was projected earlier. GDP growth projection for India for this financial year came in at a growth target of just 6.4%. Now, this is the slowest that India's GDP growth has been in over 5 years, and inflation in the meantime continues to be above 4% despite the RBI cutting the key lending rate, the repo rate. Add to that the pain coming from the corporate sector, just an average of 5% profit growth by the Nifty 50 companies, showing that there is also a consumption slowdown. Well, things could change perhaps in the new financial year with the tax SOPs that have been announced in the budget, which could drive up the consumption story. But that may not be enough to offset the FII outflow. Amit Kumar Gupta, founder of Fintrekk Capital, joins us this morning. Amit, good morning. Thanks for joining us back here on News 9. I want to understand basic questions. Markets continue to bleed. Investors are seeing their wealth wipe out. How long is this pain expected to continue?
Hi, Kartik. Good morning. Thank you for having me. The markets are eventually reflect what is happening in the economy, and the broader economic growth momentum has stalled in the past 6 months or so. The impact of the massive COVID stimulus that sort of negated now. Most of the agencies are gradually acknowledging that the real GDP growth might be in 6 to 7% kind of a band. As the latest union budget has also depicted that the fiscal leverage to stimulate growth that has also mostly dissipated. If you talk about like the central government capex, that has sort of peaked around 3% of the GDP. Even at the state level, the total public capex is sort of stuck at 4.5% of GDP. So the scope of increasing government consumption is limited, and completely dependent on how the tax buoyancies happen.
Right.
So even with these aggressive tax revenue assumptions, the government revenue expenditure is not expected to be more than 5% of the GDP,
Right.
which was somewhere 7.5% pre-COVID.
Right.
So my sense is that all these macro drivers of growth, whether it is consumptions, investments, even exports now because of the tariffs, things coming along, they're all facing headwinds. And
Right.
at this point of time, it appears unlikely that these will get resolved in the next 1 or 2 quarters
Okay.
before we actually start seeing any substantial improvement. So
Okay.
my sense is, this is sort of a consolidation period. We have to see how all these things come together in the next 3 to 6 months, and then I think market would sort of bottom out fundamentally. At least it may bottom out technically a little bit ahead because markets are a little ahead of the economy. But I think fundamentally, sometime in Q2 only of the next financial year, we'll see some fundamental bottoming happening, and then gradual recovery.
All right. Now, I think the basic question that all investors really want to, in addition to a timeline, try and get is what should their strategy be in such volatile markets, and volatility tending to be more negative than positive as days go by. So SIPs, I mean, there is data coming in. There has been a gradual increase in SIPs, but the total number of folios has reduced. So overall, what should be the right strategy for investors in these difficult times? Because the mistake, to my mind, most investors tend to do is they buy high and they sell low. So right now, do you call this a correction? Do you call this pretty much close to the bottom, if not a bottom out? And for those who continue to stay invested, is there going to be a substantial upside as we saw, let's say, 4 years ago when we were just coming out of COVID?
Yeah, right. I think the current phase is a corrective decline after a very strong 4 years of bull market. This bull market started with the COVID bottom in March 2020, and now have sort of entered a corrective phase since end of September, start of October last year. But I think unlike the phase, let's say, which was there in 21-22 when the Russia-Ukraine war sort of broke out, I think the market dynamics are very drastically different currently. There is much more retail participation, there is much more HNIs and family offices participations.
Yeah,
And, the way the last 6 months of the last calendar year worked out, there was mad rush to IPOs, there was mad rush to SMEs, unlisted space, private markets, a lot of money has gone into that. So I think the market dynamics in general are very different from what it was,
sure.
4 years before that.
Right,
So in usually such a corrective decline phase, we see both time and price correction happening in stocks.
right.
I think a lot of the price correction is already there,
Okay,
but there could be further time correction happening, which I said, could be 1 or 2 quarters more. So investors need to pick their stocks carefully, calibrate their cash positions
right.
accordingly, and as industry specific data gets more and more clear, then they can look to increase. But my sense is to have some discipline, keep the sips going,
Okay,
don't churn unnecessarily from schemes to schemes or
right.
from themes to themes. See how newer themes are developing, because every bull market brings new themes, and the old themes actually take a back seat.
Sure.
So the themes like defense, railways, which were the leaders of the bull markets last time, I think that they will take a sort of a backseat. And we have been very consciously, because of high valuations, we have been exiting those kind of stocks in the last year itself.
Right.
But I think because the pendulum has swung now to the different direction, there
Yeah.
are definitely opportunities to buy,
Okay.
even fresh at these levels. Uh, but one needs to just temper their expectations of a V-shaped recovery
All right.
in the stocks.
No V-shaped recovery for the foreseeable future. One final question before I let you go. Amit, gold is also at an all-time high, touching almost 89,400 odd levels in India. Should gold allocation increase in your portfolio, or this is the time to actually stay away from gold and not add anything at this value?
No, I think gold is currently driven by a huge central bank buying, which is currently happening.
Right.
Along with that, obviously there is a lot of uncertainty with what will happen to Trump tariffs negotiation over the next 3 months or so. So gold is a beneficiary of that, but I will not be a buyer at these levels. If somebody is holding from the lower levels of 2000, 2,200, then they can hold a little bit longer, because I see a 5 to 7% more rally from the current levels as well. But I would not buy fresh on this levels. I would probably, in the next 3 months or so, I would be actively looking to actually decrease my gold allocation. As the uncertainty gets removed, because then there will be a surge of profit booking happening. The people who are getting in the long end, they would offload their position. So probably it's a time to actually take the chips off the table,
Right.
reduce gold allocation a little bit over the next 3 months.
All right, reduce allocation on gold. This is definitely not the time to buy. Gold is the word coming in from Amit Kumar Gupta, who's also saying that continue with those SIPs and don't really churn unless you really need to. Amit Kumar Gupta, thank you so much for joining us.